MACD is one of the most misunderstood indicators on a chart, and my view is simple. It is not a buy signal by itself. It is a momentum tool. That means it helps me see whether price movement is speeding up, slowing down, or changing direction, but it does not tell me whether a trade is good on its own. If you treat MACD like a magic switch, it will mislead you. If you treat it like a read on trend strength, it becomes much more useful. MACD stands for Moving Average Convergence Divergence. In plain English, it compares two moving averages of price, usually the 12-period and 26-period exponential moving averages. The faster average reacts quickly to recent price changes, while the slower one reacts more slowly. The MACD line is the difference between those two averages. Then there is a signal line, which is just a smoother version of the MACD line. When the faster momentum starts pulling away from the slower trend, MACD expands. When that momentum fades, it contracts. The basic way traders use MACD is to watch crossovers, the histogram, and the zero line. A crossover happens when the MACD line moves above or below the signal line. Many traders read that as a shift in momentum. The histogram shows the distance between those two lines, so it helps you see whether momentum is strengthening or weakening before the lines fully cross. The zero line matters because it shows whether the faster average is above or below the slower one. Above zero usually means the shorter-term trend is stronger than the longer-term trend, and below zero means the opposite. Here is where beginners usually go wrong. They use MACD as if every crossover means a trade. That is a bad habit. In a strong trend, MACD can stay bullish or bearish for a long time, and early counter signals can fail repeatedly. In a choppy market, MACD can flip back and forth and produce a lot of noise. So the indicator is not wrong. The market condition is changing. I want MACD to confirm what price is already doing, not replace price action itself. The cleanest use case is trend confirmation. If price is making higher highs and higher lows, and MACD is holding above zero with the histogram improving, that tells me momentum supports the trend. If price is breaking down and MACD is below zero with the histogram weakening, that supports bearish pressure. I also pay attention to divergence, which is when price makes a new high or low, but MACD does not. That can warn me that momentum is fading. It is not a reversal signal by itself, but it is a useful caution flag. MACD tends to work best when the market is trending and there's enough movement for momentum to matter. It tends to fail in sideways ranges, low volatility conditions, and late-stage moves, where the indicator reacts after the important part of the move is already over. That lag is built into the tool. Moving averages are smooth by design, so MACD will always be a little late. I accept that trade-off, because I would rather have a slower, cleaner read than a fast, noisy one. My practical rule is this. Use MACD to support a trade idea, not to invent one. First, identify the market structure on price. Then use MACD to judge whether momentum agrees with that structure. If they line up, I have better context. If they disagree, I slow down and ask whether the market is trending, ranging, or losing force. That is the right way to use MACD, as a filter, a confirmation tool, and a warning system.